Many analysts believe the global economy is heading toward a major turning point. Between 2026 and 2028, several indicators suggest financial markets may face one of the most dramatic declines in decades. The biggest warning sign is the Federal Reserve's higher for longer interest rate strategy. Persistent high rates push borrowing costs up, straining both consumers and businesses across nearly every sector. High interest rates usually cool the economy, but when they stay elevated too long, they begin to crack weak foundations. Debt-filled companies and fragile markets struggle to survive under these conditions. American households are experiencing historic financial pressure. Credit card debt, auto loans, and student loans have all reached record highs, showing that consumers are running out of financial room. When consumers become over-leveraged, spending slows sharply. Since consumer spending drives most of the U.S. economy, any sudden decline can trigger a chain reaction that affects stocks and corporate profits. Meanwhile, the housing market remains dangerously overheated. High mortgage rates should cool prices, yet shortages keep them elevated. This creates a fragile bubble, waiting for the right trigger to burst. Commercial real estate is an even worse condition. Office vacancy rates continue rising, especially in major cities, placing enormous stress on regional banks deeply exposed to property loans. If commercial landlords begin defaulting, banks holding their loans could face significant losses. This could create a banking shock similar to or worse than what happened in 2008. Many experts argue that the stock market is inflated by speculation, especially in the technology sector. Some companies are valued far beyond their actual earnings or realistic future growth expectations. The hype around artificial intelligence has fueled massive investment. But like the dot-com bubble in 2000, excitement can create overpriced assets that collapse once growth slows or expectations shift. Investors often overlook the cyclical nature of markets. Historically, major crashes occur every 15 to 20 years. The timeline suggests that we are approaching another potential downturn. Geopolitical tensions are also raising concerns. Trade conflicts, wars, and energy disruptions increase uncertainty, pushing investors to question whether markets are truly stable or simply overconfident. China's economic slowdown adds another layer of risk. As one of the world's largest trading partners, weakness in China can ripple through U.S. markets faster than many realize. Global supply chains remain unstable. Even small disruptions can cause price spikes, shortages, or production delays, increasing volatility in both manufacturing and stock markets. Corporate debt has ballooned over the past decade. Many companies borrowed heavily when rates were low, and now they face difficulty refinancing at significantly higher rates. As refinancing becomes more expensive, weaker companies may default. These failures can create fear in markets, causing investors to flee risky assets and accelerate declines. The U.S. national debt continues rising rapidly. Large deficits can limit the government's ability to respond effectively in a financial crisis, worsening the overall impact. If investors begin doubting the government's capacity to manage debt, bond yields may spike, stressing the entire financial system and adding pressure to already fragile markets. Tech stocks represent a major portion of the market's current growth. If these companies face earnings disappointments, the entire stock market could experience sharp and sudden corrections. AI investments have created unrealistic expectations. While AI is transformative, not every company will profit. When reality catches up, overvalued stocks may fall rapidly. Consumer confidence remains fragile. Any sudden shock, a bank failure, geopolitical conflict, or earnings crash can quickly shift sentiment from optimism to panic. Banks are tightening lending standards due to rising risks. When credit becomes harder to access, economic activity slows, making markets more vulnerable to downturns.
Some analysts warn that a liquidity crisis could emerge if markets panic. When liquidity dries up, asset prices crash faster because buyers disappear just as sellers surge. Investors are increasingly turning to safe assets like gold and treasury bonds. This shift suggests growing fear that riskier markets may face turbulence in the near future.
Corporate earnings growth is slowing. As profits weaken, stock valuations become harder to justify, creating the perfect environment for a potential market correction. The wealth gap continues widening. When economic inequality grows, social and political instability becomes more likely, adding uncertainty to financial markets. Retail investors, encouraged by social media, have poured money into markets without understanding risk. Speculation increases volatility and can magnify crashes when sentiment shifts. A new generation of investors has never experienced a major crash. Their lack of experience may contribute to overconfidence, making the market more vulnerable to sudden panic. Energy markets remain unpredictable. Oil supply disruptions or sudden demand shifts can spark inflation spikes, forcing central banks to react aggressively. Inflation remains sticky in several sectors. Persistent inflation keeps pressure on interest rates, preventing central banks from providing economic relief when needed. If inflation rises unexpectedly in 2026, the Federal Reserve may be forced to implement additional rate hikes, adding stress to an already fragile financial environment. Global investment is shifting toward emerging markets. As capital leaves the U.S., asset prices can weaken, increasing the possibility of sharp market corrections. Cryptocurrency volatility introduces new risks. Sudden collapses in digital assets can shake investor confidence across traditional markets as well. Market optimism can sometimes create dangerous illusions. When investors believe prices can only rise, they ignore warning signs until it is too late. Large institutional investors are quietly preparing for turbulence. Their defensive strategies suggest that professionals expect significant volatility ahead. Government stimulus may not be available during the next crisis. With rising debt, policymakers have fewer tools to stabilize the economy quickly. Some economists believe the next crash will start in the credit markets, not the stock market. When credit tightens, everything slows down at once. The housing affordability crisis continues worsening. When homes become unaffordable, demand weakens and prices can fall sharply, hurting homeowners and banks alike. The global economy is more interconnected than ever. A crisis in one region can spread rapidly, making the next downturn potentially larger and faster than previous ones. Market bubbles do not pop slowly. They burst suddenly, leaving investors little time to adjust before losses become overwhelming. Many signals point toward rising market fragility. While no one can predict the exact moment, conditions increasingly resemble those seen before previous major crashes. Investors should be cautious of overly optimistic forecasts. When markets are priced for perfection, even small disappointments can trigger large sell-offs. The coming years may reveal whether the economy has been artificially supported by low rates and stimulus, or whether true growth has been achieved. If markets correct sharply, long-term investors may find valuable opportunities. Severe declines often reset prices to more realistic and sustainable levels. Risk management becomes essential during uncertain periods. Diversification and discipline can help protect investors from large losses during volatile market phases. Remaining informed is the best strategy. Understanding economic signals helps investors react calmly rather than emotionally when turbulence strikes. Whether a crash occurs depends on how global markets respond to pressure. Stability requires confidence, coordination, and strong economic fundamentals. The question remains, will 2026 to 2028 mark the next major market crash, or will this be another false alarm? Only time will reveal the truth behind the warning signs.